Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast for this Wednesday, November 25th. My name is Ian Saunders, and join us here as well as Sara Maley. And Sara, we're coming into an abbreviated week from a trading perspective here, with the at least here in the U.S., with the Thanksgiving holiday being celebrated there tomorrow on Thursday, November 26th. So markets will be closed then. And just as a brief PSA, given that the markets will be closed, our offices will be closed as well, but we'll be back open there on Friday for that half-day market session, with markets closing at 1 p.m. there on Friday. So Sara, typically we have this week typically pretty light trading volume around this holiday week, with people maybe traveling most years, but I guess maybe because of the lack of as much travel this year, or just the rest of the stuff going on in the market, seeing some nice participation to the upside from some major indices here.
Yeah, so one thing I think we can all be thankful for this Thanksgiving season is yesterday we saw the Dow Jones Industrial Average cross the 30,000 mark for the first time, and actually it was able to close above that level. And one thing that we do track, what we've tracked over the years since 1972, is just the amount of time that it's taken for the Dow to cross these 1,000-point thresholds. And so we saw the Dow cross the 29,000 mark back in January. So this took about 314 days, almost 90% of a year to rally 3.45%. And just in comparison, it took just from that 28,000 mark to 29,000, took just 61 days. So this is the longest, 1,000-point duration rally that we've seen since the index went from 26,000 to 27,000. That was about 540 days. So just some interesting little data points there, which we will be putting in our daily equity report today. So again, Dow's back above, or is now above 30,000. We saw give that buy signal, second consecutive buy signal on its 250-point chart. And so we are seeing it, nearing overbought territory. Not too overbought at this time, but that is something that we will keep an eye on. And we've also seen some other indexes, print these new all-time highs. Yesterday, we saw the S&P Equal Weighted Index print a new all-time high. And we have also seen, today we actually saw the NASDAQ Composite hit a new all-time high. We have not seen the S&P 500 nor the NASDAQ 100 indexes recover back to their all-time highs, just as we have not seen the mega cap names, continue to follow through or participate as much as those smaller or less mega cappy names have done so. So just to wrap up, we've seen the S&P 500 Equal Weight Index hit a new all-time high yesterday, along with the Dow crossing that 30,000 point, which also marked a new all-time high. And today we saw the NASDAQ Composite print that new all-time high. And just one more thing about the Dow, we are on track right now for the best month on record since 1987, since January of 1987. So that is something that we're going to continue to monitor as well. So just a really stellar month here for the month of November. And we've seen this positive action, translate into strength for U.S. equities as a whole. In Dolly, we've seen the signal count, as we mentioned last week, move above that 300 mark. We're now sitting at 322 tally signals. We saw that jump from 317 to 322 just yesterday. So these all-time highs and the broad participation, we are seeing that translated over into a strengthening for U.S. equities as an asset class. And we've also seen some strength, Ian, from the international space as well.
Absolutely. The broad strength is really kind of hits the nail on the head for equities as a whole. Both domestic and international equities have obviously fell significantly out of favor in our dynamic asset level investing, our Dolly tool, with the market decline that we got there in March. Or really in the first quarter as a whole for the case of international, but it rallied back pretty substantially. International lagged a little bit, took a little bit longer to rally back. But as Sara said, that the broad strength is something that's not just being seen within domestic. We're seeing that carried over to international, and actually saw a buy signal improvement of 20 signals after market close. After market close on Tuesday alone. So it's international equities gained 20 signals yesterday alone to move to its current buy signal tally of 197 buy signals overtaking fixed income, which lost 9 signals yesterday. So international equities now sits 11 signals ahead of fixed income. And it's firmly in that second ranked positioning there on the Dolly broad asset class rank. This, for those of you that utilize maybe some of our Dolly tilt strategies, this isn't going to change all that much for many of those strategies. Looking specifically at the aggressive strategy and the moderate strategy, because those had most of or all of the remaining allocation already defaulted to be put into domestic equities, since it moved back into the #1 position there in late August. But for those that do use the conservative tilt strategy, this will increase your allocation there for the international equities asset class. So just something to keep note of. Obviously, for those of you that have a subscription to the platform, you can certainly set alerts on any kind of further movement to be notified of any further changes from an asset class perspective. But in looking at the international equities asset class, it's definitely, I mean, it's moved up pretty significantly from that buy signal rank, jumping just over the past month alone from a rank of 5th in an asset class perspective all the way up in the 2nd. So we're seeing a pretty significant gain from relative strength perspective for the broad asset class. And then looking underneath the hood at what exactly led to some of these changes, really, I mean, going back to that conversation of breadth, right? We're seeing a lot of these areas that had maybe lagged the leadership in international equities, which had really been the emerging market areas of China and Taiwan, as well as some of the Europe countries in the Nordic region. Really had kind of led the way for most of the international equity space throughout much of the broader rally. But some of these laggard areas have begun to pick up the pace a little bit as well. Looking specifically at the broader Europe with heavier allocations to the United Kingdom, showing some improvement, as well as just developed markets as a whole. The broader developed market fund, ticker EFA, the iShares MSCI EFA ETF, has continued to lag EEM from a performance standpoint throughout this market rally that we've had. But with movement over the past few days, has actually just moved back into positive territory on the year and moved back above its January chart high of 70 to a chart level of 71 with movement there on Tuesday. So still continues to lag the broader EEM from a score perspective, but it did move back above a fund score of 3.0 and has further separated itself to its current score position of 3.14 with movement there this week. So continue to see that kind of improvement from a laggard area just in looking at the broad emerging versus developed. Developed has continued to kind of pick up the pace over the past several weeks and is now looking significantly more favorable from a technical perspective and helping out the broad strength of the asset class as a whole. Another area that has continued to kind of lag is the frontier market. So taking the flip side, moving from developed all the way to the other side, looking at frontier markets, there's a ticker that we track on the platform, the iShares MSCI Frontier 100 ETF, ticker FM, has been an area that has really kind of shown a lack of improvement throughout much of the year, falling to a low of 1950, a multi-year low back in March of this year, and has moved higher off of that low, but has failed to move back to a positive trend up until movement there Tuesday as well. Tuesday's movement led the fund higher and had already given 2 consecutive buy signals, the last one occurring there in August at 25, and then has continued to rally over the past several months, moving it to a current chart position at 28, which will put this fund back in an overall positive trend. So talking about that laggard improvement isn't something that we're just seeing in the domestic equity space, also something that we're seeing carried over the broader international and global equity space as well, with some of these areas that might not be quite as favorable from a score perspective, but showing that consistent improvement to bring the strength of international equities as a whole higher. But I mean, not to just focus on international equities laggard improvements here. We've also seen some interesting laggard improvement over the past week, especially from some more focused areas within domestic equities.
So some of those laggard areas have been, areas like energy, oil and gas, things like that. And with today's action, we actually saw oil and gas exploration and production, XOP is the symbol there, as well as broad energy by way of XLE rotate into the State Street sector model. And this particular model is using what we call an RS versus benchmark methodology. So it's comparing the relative strength of each of these individual sector ETFs versus the S&P 500. So while when we rank the sectors, energy remains, a weaker area. When we're just looking at its, movement relative to the S&P 500, we have seen energy with its recent, laggard rally outpace the S&P 500 enough to create that reversal on that relative strength chart, which causes that these funds to move into the model. So this week we saw energy and oil and gas exploration production. Last week we saw oil and gas equipment and services rotate in, along with metals and mining. And then the week before we saw regional banks and along with broad bank exposure rotate into that model. So that's an interesting one to see there. I believe there are now 18 positions within that model, equally weighted at 5.55% each. So we'll just continue to monitor that, see if there's any more, how many more sectors are able to show that outperformance relative to the S&P 500, just showing that there is some strengthening there. We also saw energy rotate into the first trust sector model as well, which is also another one of the RS versus benchmark models. So like you said, we're seeing some of these areas rotate in from a long-term perspective, like you said, and from a score perspective. They're still, relatively weaker areas, but definitely something to keep an eye on. And one other thing to definitely keep an eye on, we just opened up registration for our NASDAQ Dorsey Wright Virtual Symposium. This is going to be an online event hosted on December 10th from 12 p.m. Eastern to 4 p.m., so about a half-day event. We are going to have a website available that will actually have embedded Zoom links in it, so you don't have to jump back and forth to Zoom, but we will send that out once you register. But to go ahead and register, just please go to our Were You Aware that will be posted today or the past previous days for that registration link, or feel free to email me, Sara, S-A-R-A, M as in Mary at dorseywright.com, and I'll be sure to get you that information. We do have some continuing education credit approval pending for CFP and SEMA, so we will keep you up to speed on that, but we definitely invite you to join us for our virtual event, just because we're not able to meet in person this year. So while this isn't taking place necessarily of a bigger institute that we typically host, this is a half-day event that we're excited to bring to you.
Wonderful. And that definitely be a great opportunity there to maybe get some, be able to speak with some more individuals recently. And that is, again, open to both subscribers to our platform and not subscribers as well. So those of you who are listening who are not subscribers to the platform, definitely going to be available to sign up for that. You can shoot us an email at dwa@dorseywright.com. That's something you might be interested in. You're also more than welcome to shoot us an email about any other kind of questions you had about maybe the topics we touched on today, or anything else you're seeing and going on in the broader marketplace. If you'd rather talk to us too, you're always more than welcome to give us a call at 804-320-8511. So with that, Sara, I think that pretty much covers most of what we're looking to cover today. So thank you for joining us here this week, and thank you to everyone listening in. And we hope to have you back next week.
And happy Thanksgiving.